Good morning and good afternoon or wherever you are today, and welcome to today's web seminar on preparing your business for the new RevRec standard, ASC 606. I'm pleased to be speaking with all of you this morning, and let me go ahead and give you a quick overview of what we're planning to speak to today. So I'm going to go ahead and spend a few minutes walking through introductions. I'll give you an overview of NetSuite, and then we'll spend the bulk of the time in an interview with NetSuite's Global Controller, Mike Foreman. I'll introduce him, of course, later on. And then, of course, we'll make sure that we leave plenty of time at the end for audience Q&A. Of course, if you do have questions throughout the presentation, please feel free to go ahead and type those in. If we do have time, we'll make sure that we get to those. If we don't have time to get to your question, I do know we have a very large audience today. We'll make sure that someone follows up with you a few days afterwards and answer your question personally. So with that, let me go ahead and dive right in. So, of course, introduce Mike in a moment and give you a broader introduction to him and his bio and really his background. But before I do that, let me go ahead and introduce myself. So my name is Ranga Bodla. I'm responsible for industry marketing here at NetSuite, and I'm based out of our Chicago office, and I manage all the different industries that NetSuite goes to market. I've been at NetSuite for about 6.5 years, and over that time, of course, I've seen it really transform from around 900 employees to where we ended last year, well over 5,000 employees. So to give you a quick introduction into NetSuite, and just to give you a brief overview here, NetSuite, most of you hopefully already know who NetSuite is. If you're on this, if you received an invite, we're glad to be speaking with you. But if you don't know, we were really the first cloud company. We were founded in 1998 with the goal of delivering a single cloud-based system to run an entire business. We have over 5,500 employees globally, and over 40,000 organizations and subsidiaries trust NetSuite to run their business day in and day out. We ended 2016 with almost $1 billion run rate, and were acquired in late November by Oracle for $9.3 billion. Now we operate as a global business unit of Oracle. So if you really look at what NetSuite does, it really starts with the Suite Cloud platform. Suite Cloud is a pure cloud, multi-tenant, built-in platform that underlies our application and really provides a strong foundation for what we do. On top of that, we have our market-leading ERP, CRM, services resource planning, and commerce system, all built on that single unified data model. And of course, with OneWorld, we're able to handle the difficult task of going global with multi-book, multi-language, multi-currency, and of course, multi-country tax compliance. All, of course, which have been very critical for us in running the entire company on NetSuite, which we do run NetSuite on NetSuite. And of course, we use all of this to drive our success across the many different industries that NetSuite operates in, whether that's software, services, advertising, media and publishing, nonprofit, manufacturing, wholesale distribution, and of course, retail. And all of this is what enables these 4 key pillars of NetSuite. One unified system with a single schema and a single global record for all your key entities. Point-and-click flexibility and the ability to run the entire business on a single global verticalized ERP. All of these are what has enabled us to have the broad market success and the adoption of our solution that we've seen over the years. So with that, I want to go ahead and now move us on to the main program. So let me just take a quick few minutes to introduce who Mike Foreman is. If you have never met Mike, Mike's a great guy. I'm really excited to be presenting with Mike. Gotten to work with Mike over my career at NetSuite, and it's great to work with such a strong financial executive. Mike, of course, has been with NetSuite for almost 13 years, and he started with NetSuite when they were just a private company with just under $20 million in revenue. Mike was tasked with developing and scaling a finance infrastructure in preparation to file the S1 and take the company public in 2007. Additionally, Mike led the efforts in our transition to EITF 0801, and of course managed due diligence and integration for a number of acquisitions that NetSuite did. And of course for 606, Mike has been a key leader in leading our transition to 606 and all the related tasks that go with it. I'm really excited to have him join us today and share his perspectives on 606. Thank you, Mike, for joining us.
Great, thanks. Great to be here, Anya.
Like, why don't we go ahead and dive in, Mike? When you first heard about 606, first let me ask, when did you first kind of get involved with 606, and were you concerned?
So sure, yeah. I mean, anytime FASB decides to come out with a overhauling a real significant area like revenue recognition, and in this case, I think which nearly impacts every company to some extent, you have to be concerned about the size of a project like that. So the first exposure draft came out in 2010, which really started conversation among practitioners, investors, and with regulatory bodies. So until the new rules were finally agreed upon in 14, there wasn't much you could do beyond speculate how the rules may or may not impact your particular industry and company, and try to make an attempt to help shape them by writing comment letters and working with your external auditors. Unfortunately, due to the volume of feedback that FASB did receive, they deferred the adoption date by a year, which I think has really allowed companies to more fully digest the rules and figure out where to go from there.
And Mike, can you give us your perspective on well, I guess just a quick summary. Summarize 606 for me.
Sure, I can be here for a couple hours, but I'll try to do fairly quickly. So 606 provides more of a principles-based framework. It moves away from the industry and transaction-specific requirements under GAAP, and essentially replaces existing RevRec guidance, both in U.S. GAAP and the IFRS. It also requires significantly more qualitative and quantitative disclosures to help the financial reader understand the nature, amount, and timing of revenue and cash flows that results from contracts with customers. So it's something that will impact all companies regardless of the actual impact to your RevRec numbers. 606 provides a 5-step model to guide you through how much revenue to recognize and when to recognize that revenue. The model dictates that revenue should be recognized when or as an entity transfers control of goods or services at the amount to which the entity expects to be entitled to. 606 also provides guidance around related topics. So it's not just revenue, it's warranties, licenses, capitalization of costs of obtaining the contract. So you're talking about sales commissions, and then costs of actually fulfilling the contract. So for public companies, we're required to adopt it for fiscal years ending after this year, 16. And although early adoption is permitted, after 2017, early adoption is permitted already. At this point, we've seen a few companies come out and already release what the impact is for them. And then private companies have another year to adopt. Finally, there are several adoption methods to choose from, including a full retrospective basis or a retrospective with one or more practical expedients. All of those involve restating prior periods. And then you have another option, which is the cumulative effect method, which allows you to record the cumulative effect of an adjustment to the opening balance sheet of equity at the date of an initial application. So less disclosure about prior periods, but still quite a bit of work involved.
So quite a big impact, quite a big pronouncement in terms of what's there. Mike, what I'd like to do now, I think would be good, just is let's open up to the audience a little bit and see how prepared people are for 606. So this should be interesting. So we can go ahead and open the poll. So in the bottom right-hand corner of your screen, you should see now a poll question, and we've opened that up, and we'll give it about 30 seconds for you to go ahead and answer and go ahead and give your perspective on this. But the question is, how prepared are you for 606? The first answer, of course, have not commenced preparation, established a project plan / project team, completed a gap analysis, quantified the impact, identified system processes and changes implemented, and then completed adoption process or early adoption. So it should be interesting to see how these results look across this group. We have a pretty big audience today. We'll give it another 10 seconds and let people answer. And then of course we'll make sure that we showcase the results here. But as we're doing that, Mike, any comments just on these on the answers themselves?
I'm guessing that the answers are probably depend largely on the audience. So if we're talking about private companies who still have another extra year to adopt, we'll probably see less preparation, I'm guessing, and then for the public companies, hopefully a little bit further down the road, since we are coming pretty close to having to get ready here.
All right, why don't we go ahead and close the polls at this point, and then let's see, and let's go ahead and publish those results, and we can walk through the results here quickly before we continue on. Should be interesting to see. I actually don't know how many people on here are public companies or private companies. That wasn't something we asked. So, all right. So the results have come in, and I believe everyone can see the results. And surprisingly, that there's a large percentage of folks on here that have not commenced preparation. Looks like 60% have not commenced preparation. And about 27% have established a project plan. And then looks like about 1% have actually completed the adoption process or done the early adoption. So very few people, of course, have done that full thing and been early adopters, which isn't surprising. And then, of course, a number of folks are in that completed gap analysis phase.
Looks like there's a lot of work to go in a very short period of time.
I'm guessing that's why this is such a popular topic for folks.
I think so.
Well, let's keep going and seeing if we can help people in terms of thinking about preparation. So Mike, kind of that next question really is when you heard about the changes around 606, really how did you and your team prepare? And I imagine when you joined NetSuite, we were only 20 million, that you had a much different finance team than when this came out. But given the size of this pronouncement, when you guys started looking at it, how did you guys prepare?
So first exposure draft came out way back 2010. So we didn't start our planning really until 2015 after the final pronouncement was issued in 14. And since the firms didn't really come out with any 606 guides literally until last year, we've seen actually a few more revisions this year as we've gained a little bit more insights. We spent most of 2015 reviewing the pronouncement. We had some informal discussions with other finance professionals in our industry, and of course started to kick off discussions with our external auditor, really to get a sense of how everybody was thinking about the potential impacts and how it may impact their own companies. And then in early 16, we put together a project plan which included the composition of the team. So who in finance, who outside of finance would be part of the process. We put together a timeline. We identified significant milestones, started to think about what system adjustments we'd have to make, what process adjustments. So it's not just systems. It was what are we doing even before we get to the system itself, how that may have to change. And then pulling in other departments, and this truly is a multi-departmental project. There's so many people that touch upon, not just revenue, but sales commissions and how we price and package our products. So at that time, we also sat down with our external auditors and established periodic meetings where we would select a potential gap area. And I think we came up with probably 7 or 8 at the time. We would draft a position paper on how we thought the new rules would impact that area, along with some use cases, and then we would share those thoughts with our external auditor to get their input and ultimately get their concurrence. Because I would say as we close to adoption, we have to be in sync. And so given 606 is more principles-based, the interaction, I think, with the external auditors frequently throughout the process is absolutely critical, and most likely they're going to end up comparing and contrasting your position with other clients in similar spaces to ensure there's consistency across the industry. They certainly don't want to have you go adopt and have drastically different approaches if you're in a similar business. So once we identified those gaps, we started identifying the systems, the process changes that we would need to implement. And then this, of course, involves testing some of our new functionality. specifically within NetSuite around advanced RevRec and then multi-books, especially if you're looking at potentially going with the cumulative effect adoption, which requires you to compare 605 and 606 results in the first 12 months. And then finally, we started providing our board with periodic updates about the potential impact of the new rules and how we were progressing against that project plan. And ideally, those are scheduled every quarter as you're already going through the results of the company. So they have a very solid, timely update all the way through the adoption date.
So it definitely sounds like a close personal relationship with your auditors is pretty critical during this. I'm going to bring this up later, but in fact, the next part of our series, the next webinar we're planning in 2 weeks, is actually with Prasad Kadambi, who I think you know from KPMG, who's going to give his perspective and really talk about that. So very, very relevant. It seems like that the auditor piece of this is key. So Mike, you already brought this up, but it sounds like one of the big things is, so the team here is much more than just the finance team. You said this is a pretty broad, multidisciplinary team. Who's all part of that team? Is there a difference? Was there a difference from when you did this during the ITF 08-01? And really, how did that affect the team, given these differences?
Sure. So prior to the acquisition late last year, we didn't really have resources outside of the core revenue team to work, as full-time as possible on the project. So literally every member of our small revenue team either led or participated at some level with myself and other key members of the controllership overseeing the project. And then with regards to 08-01, there are significant differences with 606 as it relates to the depth and impact between the two pronouncements. 08-01 specifically impacted revenue arrangements with multiple deliverables, while 606 wipes out all prior revenue recognition rules and establishes an entirely new framework. And 08-01 only impacted a fraction of companies, while 606 touches everybody in one way or another, at the very least from a disclosure perspective. And as you implied in your question, and I talked about briefly before, 606 impacts more than just revenue. So the rules potentially impact how a company recognizes costs in obtaining and fulfilling contracts. They touch other financial statement items such as interest income and expense due to the timing of customer payments. And because the impact of the financial model is more far-reaching, it's really critical to involve those responsible for forecasting the results of the company as well as sales operations. So they're key in developing comp plans. And then also talking with your go-to-market teams. They're the ones that are packaging and pricing your products and services. And so all of this is going to be impacted potentially one way or another by 606. So much more than just revenue recognition at the end of the day. And then finally, IT has to be pulled into the mix as you identify systems that you may have to modify or literally go out and procure to meet the new requirements, not just from how you process a sales order, how it becomes revenue, but also just as important, how you get to that information required for the disclosures, because I said it is very significant and pervasive what you have to disclose every quarter if you're a public company. And so having the ability to do searches and pull up new reports is going to be a much more daunting exercise than what we're used to today.
Seems like there's going to be a pretty significant amount of questions that get raised in terms of people's public statements, in terms of financial statements, especially from all the different ways that this can impact things, as you described. So, yeah, pretty far-reaching. Mike, given how much of an impact this has on the entire organization, are there ways to reduce that impact on the transition? Are there ways to make sure that it doesn't bog down the company and doesn't become a burden, given ultimately it's more about reporting as opposed to moving the company forward?
Yeah, I mean, I'd love to say we don't let accounting rules impact the way we run our business, but when you have something like 606, which is far-reaching, you have to take into consideration what's going around outside of just the finance group, a core group of employees. So, any senior finance professional, whether they're controller or CFO, they need to start talking with the operational side of the house as well as the board about how the rules under 606 may impact the reporting results if you just didn't make any changes operationally. So here's 605, here's 606, here's how the model changes if we don't do anything today. And then, and it's really in the shareholders' best interest to reduce disruption to a company's financial model from 606 or any accounting pronouncement because of the way that you potentially alter how you compensate sales teams or package or price your products and services. And so, unfortunately, you can't just do status quo if you don't want to have pervasive changes to your model. So those are the things you have to start to think about. And so I think the best way to minimize the impact of any significant changes like 606 is to plan ahead, like we've talked about. So, establishing detailed project milestones, tracking and reporting your progress timely, and involving those functions that will most likely be impacted early and often. And then as the FASB requires for, any type of significant pronouncement adoption, companies are required to disclose the potential impact to their financial statements prior to the actual adoption. So a fair amount of consideration has to be given to those disclosures so as to provide, some level of runway to the investors and your financial statement readers about how 606 may impact both historical numbers, if you are looking at doing a retroactive approach, and then obviously the future financial results.
Mike, let's go ahead and open up another poll at this point, and let's see what people are thinking about in terms of transition method. And and Mike, given the answers that we had on the previous poll, maybe you can talk through just briefly some of these different transition methods and what they mean. So, what transition method do you expect to adopt? Full retrospective with practical expedience, the cumulative effect. What can you just give a quick?
Sure. I mean, as a private company and being a selfish finance internal professional who has to do a lot of the work, cumulative effect probably is the least impactful or least amount of effort to pull that data together. Although you still have the kind of follow-on adoption process where you've got to follow both methods. So, that'll be quite a bit of work. But the full retrospective, I think, is obviously a much more can require much more effort among the finance group and really a lot of other folks involved in it. So I think more public companies you'll see, I think, will go down the full retrospective method because it does provide the readers much more insight about historically how your numbers would look. And so if you're trying to establish trends and give as much visibility, I think quite a few more companies will go down that route. And we're already seeing some of the early adopters choose that retrospective method.
All right, let's go ahead and close the poll and see what kind of response we get. Given that we think most of many of the companies in here may be more private, is your thought that we're going to see more on the cumulative effect?
Yes, and probably see a lot of undecideds. Give it out.
It's probably hard to decide on your transition method.
Right. I mean, until you start to get into the details of it, maybe a difficult decision to make that early on.
Makes sense. And yep, pretty spot on, right? 47% undecided, 26% with a cumulative effect, 12% with partial retrospective, and then 14% for full retrospective. Does any of that surprise you at all?
No. I mean, based on it, sounds like the audience is mostly public or private, and hasn't started very far down the road, so that doesn't surprise me at all.
Okay. Well, I think you've already kind of gone through this a little bit, but just in terms of what method of adoption would you recommend, and kind of a follow-on to that, I'll ask is does your system choice, what you have in place in terms of software, does that affect your adoption method in any way?
Sure. So in terms of making a decision about, what method to follow, I can't recommend a specific one because I think it really comes down to a few factors. And the things that I would look at when I'm coming up with that decision are first of all, how material of an impact your financials will 606 have on you? So, will investors have a different view of the company's model when they compare historical and future results? Also, trying to understand, insights of companies in your space. What are other companies thinking about doing? You don't, like I talked about, probably don't want to be the only company in your space to go select one method while everybody else does another method, because it's going to be a challenging time trying to compare and contrast. And if you're trying to provide that clarity to the investor community, you probably don't want to be on your own. And like we've talked about, some of the early adopters we've seen are potentially establishing what others are going to want to do. And so looking at how earlier adopters, what decision they're making, I think will be part of the decision-making process. And then finally, like we talked about, I think the level of effort and resources required to select a variation of, say, the retrospective method versus the cumulative effect method is going to be a big part of the decision, especially with private companies. Because, like I said, I think it takes a lot more effort to try to recast 3 years worth of numbers versus maybe just having to come up with what that cumulative effect is and then get tracking for the first year of adoption. So I think it's one of those just very significant decision points that you have the CFO is going to have that discussion with the board. And I think if you can make that as early in the process as possible, the better, because obviously once that decision is made, that's going to have a pretty significant impact on the core finance team and IT about what data they have to go mine and recast or not recast. And there's just several deliverables that are contingent on that decision. So trying to get to that decision as early as possible is great, but obviously we know that until you do your gap analysis and you try to come up with some estimate of an impact dollar-wise, you're not going to be able to take that information to the board and CFO for them to make that decision. So as early as possible, the better, but knowing that you've got to do some legwork first, is kind of a requirement.
No shortcuts, unfortunately, on that front.
No.
When you, so as you mentioned, Mike, that there's obviously a big aspect to this, particularly for public companies, that they're going to be, have to give guidance and visibility. I mean, what advice would you give to public companies, particularly, how they talk to the revenue story in the quarters immediately following the transition?
So I actually think the time before the transition is actually more critical, as investors and analysts are going to be, I think, should already be kind of prepped about the ultimate impact. And that's usually through pre-adoption disclosures, which the SEC requires. And that's in the 3 major areas that you're supposed to disclose is the expected impact of the standard. So if it's not material, then you make that statement. If you start to have a sense of what the dollars are involved, you should start to come out and disclose that. Talk about the transition method. So like we said, are you going to do retro or are you going to do cumulative effect? And then when you think you're going to adopt. So obviously some folks are going to come out and do early adoption. They'll state that. Otherwise, they'll come out and say, we feel we're going to adopt around the actual adoption timeline. So the SEC really expects that disclosures will evolve each reporting period as you get closer to the adoption. And so they're encouraging companies to consider making disclosures about potential impact on other significant matters like will this impact your debt covenants? Will it have an impact on your overall business practices? Like we talked about, it's not just a revenue issue. It impacts a lot of the other geographical places in your financial statement. So they're going to be interested to understand that and disclose that to your readers even before you get to the adoption date. And so hopefully if you've done all that preparation and you've gotten that information out, your actuals and your forecasts from 606 hopefully won't differ too much when you get to that post-adoption period. And then I think these disclosures, as you're starting to think about what you're going to put in your Qs and such as leading up to the adoption, they really should shine a light on any significant impacts to your model with the idea that investors should be able to understand which aspects of 606 are going to contribute to major changes. I mean, maybe you don't have a significant impact as it relates to revenue, but maybe it's more in the sales commissions area where maybe you were expensing before, and now you have to capitalize and amortize those costs. And so that could have an impact just on the cost side. And so I think that's why a company may elect to adopt one type of retrospective method in order to provide a better link between the past and future. So, if you're in retro, you get more visibility about historically what would have happened under 606 and now what you're going to do going forward. While cumulative effect doesn't provide that visibility, although you then have the work on the back end after adoption, having to compare both pre and post. And so, like you talked about, systems are obviously a very important part of this. And so if you have something like that we have, which is multi-books, we pair that with our RevRec functionality, we could go down cumulative effect fairly easy because we've already got something that allows us to take a transaction, record both under 605 and 606, so that we have both results and we can do those disclosures. So if you choose to go down the cumulative effect, you have that ability. So I think it's really key to understand what you have in terms of your systems as you try to make that decision about what approach you make for adoption.
Makes sense. And Mike, what in your mind is the most overlooked part of 606?
So I'm not sure there's going to be a lot of areas that are overlooked just because there's so many eyes on this topic, as you can tell from today's audience, both within internal finance organizations and the investment community. So, nevertheless, I think the most challenging aspect of 606 will be for companies to identify all the different revenue streams that exist today and how each of those streams may be separately impacted by the new rules. So, if you're a small private company, maybe you've got a couple of products at most that you're selling. So, hopefully it won't be as exhausting as, say, a large public company. Even for us, we've got a fair number of streams that we've had to sit down and really think hard about, okay, how are we packaging and pricing these? How do we work with the customer when we sell and go to market with these revenue items? And so because 606 is more of a principles-based approach, there's not going to be a lot of examples or interpretations to rely on this point, although I think the firms, public accounting firms are starting to come out with some really good guides now that should at least help us initially. So I think it's really in the best interest of finance teams to reach out to others in their industries. Hopefully you have those relationships already. You're talking to your external auditors. You're starting to compare and contrast your own use cases with other companies, their methods and approaches. And so you start to get a feeling about how others are really going to deal with this topic and whether you're on point or you're going down a very different road. And maybe that is because you've got a different way of delivering your product or packaging it. And then you've got these vast disclosure requirements we touched on before, which I think will be another significant challenge because we've not seen this level in depth before, at least in the revenue and the deferred revenue areas. And so having those robust systems to not only help you account for just the revenue itself, but being able to dig into the details behind it to provide those key disclosure requirements is going to be critical.
Makes sense. And Mike, what about your expectations, or how do you think people are going to how do you think this is going to get enforced out in the market?
So I think this will be one of the most significant rule changes that we've had in a long time. Even though it may not materially impact every company's revenue recognition, but because of the disclosure requirements around it. Revenue, since it's relied upon heavily from a valuation perspective in quite a few circles, it's always historically been highlighted by the SEC if you look at history of comment letters, restatements, and enforcement actions. So I really expected to continue to see a healthy level of attention from a review perspective. Maybe even more because there's more data available you have to disclose, and so you have to be much more clear about kind of your results and how you think that'll roll out in the future. So there's much more information out there for people to absorb and interpret. So I think it's going to be even easier for enforcement around this area for people to see what's going on.
Great. The last question I'll ask, Mike, in terms of before we open it up, and there's a number of questions that have come through that I'd like to ask you from the audience, but kind of my last question is really just what's your advice on how to get started? I think you've given a couple of examples, but maybe you can just kind of summarize for us, what's your advice on especially that 60% that are haven't even started preparation yet. What's your thoughts?
Yeah, as you know, when I thought about this question before, I was thinking, oh well, you know, most people are probably already down the road of project plan milestones, and so I wasn't too concerned. But then obviously I look at the results, and so, you know, in my opinion, if you haven't already established a project team, project plan, milestones, and at least made, you know, a fairly good attempt at a gap analysis, you probably blew behind the ball. Now, obviously, if you're a private company, you've got that extra year, and so you're probably not in a bad situation. But as a public company, especially if you're in a fiscal year of 16, you know, the pressure's on now to get moving. So I would really encourage every company to treat 606 with the urgency that it deserves by allocating the necessary resources, including, you know, headcount, systems, engaging third-party consultants, and really pursuing the actions we talked about before. So getting that cross-departmental involvement early and often with the participation from your board and your CFO, I think is essential in a successful outcome. So, you know, at the end of the day, I don't think I'd have any different approach regardless of the company environment that I was in. I think, you know, while the impact of 606 is going to vary from company to company and industry to industry, unless you really evaluate it in a timely manner with the right level of resources, you're going to end up with a much more challenging adoption process than you may have anticipated. So I think in the next couple of quarters, like people are, you know, lights are going to go on in people's minds about really how much effort this is going to require once they start digging into it. So that's kind of my thoughts. Like, I probably wouldn't do anything differently. I would still highly encourage getting ahead of it as quickly as possible.
That makes sense, Mike, and I appreciate your thoughts on that. What I want to do now, and I know there's been a number of questions that have come in, and so I'll try to summarize and ask a few of them, and some of them are fairly specific, Mike. So I'll ask them, but if you're not comfortable, obviously, on some of them, just let me know. But one of the ones I just want to start off and answer kind of more generally is there's been a number of questions just in general about, how does the NetSuite solution meet some of these pieces? Are we planning to go in and dive into some of those details? And the short answer to that is we have, as part of this webinar series that we're doing, we do have the next part of the webinar series in which we're talking to Prasad Kadambi from KPMG, and he'll give his perspective. We are talking to Merrill Lynch and getting the Wall Street perspective, and we're ending the series with a full explanation of the NetSuite solution, which of course can address and handle everything around 606, regardless of adoption method. So we'll definitely talk about that in a later webinar, but we definitely encourage all of you to attend those. So, Mike, let me ask, there's been a few questions, and I don't know if there's the easy way to summarize this, but I'll ask it anyways. There's been a few questions that have come up in regards to IFRS, GAAP, and 606, and I don't know if that's I don't know enough to know whether that's an easy question or a hard question to answer, but is there anything you can give in terms of some details around that?
So I'll be honest, we didn't get into much around IFRS. My understanding, though, is that the governing bodies of FASB and IFRS were trying to get to a point where they would merge their rule sets. And while they made some attempts with RevRec and leases, and there's quite a few other ones that are down the road because they're trying to give people a more consistent view globally about companies' financial results. So many companies are now global and going all over the place. In terms of RevRec and some of the other ones, there are still some differences between IFRS and what FASB's come out with. And so you'll have to go there. And the guides are actually fairly helpful. I've been through a few of them already, and they certainly do touch upon some of those differences. And so, having those resources, which I think are very easy to get to now, will be key in trying to understand what level of effort you now have to deal with if you're having to report results under IFRS. And then under FASB, as a public company within the U.S., we're only obligated to do FASB SEC rules. But obviously, if you're doing issuances under other markets or you're issuing, statutory accounts that have RevRec on them, then you have to start considering what the requirements are under IFRS as well. So it does become even more daunting of a challenge when you've got now two sets of rules that you've got to interpret and to push into your financials. So even those people have to start even earlier than this process. I mean, I wasn't even thinking about that, but that does become an even bigger challenge.
But that's only, I mean, just even for my own knowledge, that's only if you're, and we're obviously operating globally, but we didn't have to worry about it because we're not doing statutory issuances outside.
Well, so, our model, at least NetSuite, before we were acquired by Oracle, was fairly straightforward because for the most part, our sales were made out of the U.S. entity. And so all of our revenue recognition was made out of the U.S. So when you even looked at the statutory accounts, there wasn't a lot of revenue from customer contracts that we had to consider. I think we had like maybe one or two subs, and the dollars weren't significant. So a lot of the revenue we were generating over in EMEA and in Asia Pac was actually, technically on the contract of the U.S. entity. So we didn't have to worry about the stat accounts of those foreign entities as it relates to RevRec.
Makes sense. This is another, it's fairly specific, but it's an interesting question, is what impact does 606 have on VSOE?
So VSOE goes away. It's not considered a part of the rules at the end of the day. ESP, estimated selling prices, really becomes the rule. So the hang up around VSOE and having that for undelivered elements, that's not an inhibitor to recognizing revenue earlier. So that changes the game from the traditional on-prem software companies. Fortunately, we didn't have to worry about that as a SaaS. We've been SaaS since day one, so we've not had to transition from perpetual to a SaaS environment, so that won't be an impact for us. I will not say I'm a guru when it comes to perpetual software accounting. We've been pretty much down the SaaS road the entire time.
Makes sense, yeah. Given we've only been doing SaaS, it makes it a little harder since all these rules have been in place since then. You mentioned earlier that 606 affects sales operations and compensation plan design. The question is, can you elaborate on what needs to be kept in mind with regards to compensation plan design? And obviously, I mean, you're not necessarily down in the weeds of sales compensation plan design, but maybe you could talk just a little bit about some of the impacts on expenses and things like that.
Sure. There's a lot of, I was just reading through a guide just last week, but there's a lot of nuances around what expenses you can actually capitalize as part of marketing, how you pay out your reps. Are they strictly based on, do they just have to be around in a year from now to get part of the deal? Or does something have to happen from a customer perspective? They have to renew? So it really does come down to how you structure those payments and how those are linked to the actual original transaction. Because now there's a lot of discussion around, and the rules are coming out, they're basically saying that, before a lot of companies were simply taking that initial transaction and whatever commission that was, and then they were just bringing that over that initial contract. And now the rules are really coming out to, now you got to start to consider about what the expected life of that customer is. And so you have to incorporate not only the commissions you pay on the initial transaction, but also around the renewals. And so you have to start comparing then, how do you compensate your renewal reps versus your new business reps? Are the rates commensurate? Typically they're not. I mean, typically a big part of the effort is trying to get that new customer into your customer base. And so you're typically paying a much higher percentage of commissions to that rep than you are to one that is simply just trying to keep the customer on board. And so there are a lot of factors you have to take into consideration about how that will ultimately get reflected in your financial statements and then in your model. So, to completely ignore that and forget about how that may or may not impact your financials based on your plan is probably not a good route to take. So that's why I think it's really critical to get in front of your sales team and your compensation teams, explain to them, okay, if we go down this road, this is the impact of the financials and the model. If you decide to tweak it this way, this is the impact. So, like we said, getting that cross-departmental involvement early and often, I think, is really important.
That sounds like the definitely has a lot much bigger impact in terms of in regards to that. Mike, so there's a couple questions in regards to the methods, and so I don't know if you can answer this, but what's the difference between a full retrospective and a retrospective? What's the difference between retrospective with practical expedience and cumulative effect?
So retrospective, like we talked about, actually has a couple of nuances to it. There's several layers of it. So there's the full retrospective, which is literally go back to any contract that had an impact on your prior 3 years and restate that under 606. There's retro with practical expediences, and there's I think 2 or 3 of those, and those key in like, oh, did you have a contract that actually ended during that year prior to adoption? And so if you take that route, then you don't actually have to worry about that particular contract versus doing everything. And then there's a couple more expediences, which I won't go into. And then cumulative effect, like we talked about before, is literally as long as a contract ended before your period of adoption, you don't have to touch it. So, and then for any contracts that are still open, have revenue to recognize or obligations to deliver, those are the contracts that you're going to modify in order to come up with this cumulative effect of your balance sheet at the date of adoption. And so you may very well, if you would recognize revenue earlier under 606, you'll essentially have lost revenue in a sense because you're not recasting prior years. But then again, under cumulative effect, you have to represent, well, I would have recognized that revenue earlier, and so now it's no longer going to be in my deferred revenue balance, and so now I don't get to recognize it after adoption. So in a sense, you've lost some revenue. I think some of the questions that we've seen talk about this haircut mentality.
Yeah.
So, haircuts are thought about when you do an acquisition and you have to fair value your deferred revenue. So in a sense, this is what's happening. You're not going to get credit for that revenue ever. You didn't get credit for it historically, nor will you get credit for it going forward. And I think that's why you'll see some companies say, we've got to do some form of retrospective because we don't want to lose credit for sales that we made historically.
Makes a lot of sense. I think we have time for really just 2 more questions, and then I'll just summarize up with a couple of other housekeeping. But the question, it's a good, great question here about, you had mentioned this in the thing about the life of the customer contract. It says, how are you going about estimating the life of each customer contract?
So it's actually, I think what they're referring to is the life of the customer in a sense, because you may have several contracts with your customers.
Right.
You have the initial one, you've got renewals, you've got upsells, and so there's a variety of transactions you're going to have with your customers. So because we've been around as long as we have, we've got great history. Of course, using our system, we've got great information to go mine, but we can look at and we can figure out what our average customer life is. How long does a customer stay with NetSuite throughout their evolution? So first, getting a handle on that data is key, but then what we've started to look at is, okay, how much commissions do we pay in that first year if, say we're doing, for the most part, 1-year initial contracts, and then we're doing follow-on renewals. What is that commission amount that we're paying to that rep in that first year? What is then that commission amount we're paying each renewal? And then trying to understand what that total commission amount looks like over the whatever number of years are that your traditional customer lasts. Because the idea is to effectively try to reflect that compensation over the contract term. So some of the discussions around, well, how would you ultimately recognize that commission expense? There's some discussions around would we do a waterfall throughout the whole customer life? Would we pick some kind of weighted average period and then take all those commissions that we've earned and recognized in each particular month or quarter? And so I think there's still a lot of discussions going around about how companies will approach that. And I think everybody was more focused around RevRec under the 606, not as much about the amortization, capitalization of sales commissions. I think that's going to start to heat up now as people are starting to get more insights, because I think that was not talked about as much in the earlier guides. The ones that I'm seeing today now are starting to provide a lot more information around that. So I think it's going to generate a lot of good discussion. It's going to be very helpful for people. But then again, it's that point where you should go out, talk to others in your space, talk with your auditors and try to get a sense of where their thoughts are as well.
Seems like that would actually be a good set of questions for us to ask Prasad as well. Absolutely. Get some perspective on what he's seeing from the different customers he talks to. Well, maybe the last question I'll ask, and I know you mentioned this, that most of your experience obviously has been in a SaaS business, but really this question is, what are the implications if you're a SaaS business? Are they different, as compared to, say, a non-SaaS business?
So certainly, I think I've seen a few SaaS companies early come out and early adopt, and then when I look at our own experience just from NetSuite, forgetting about a post-acquisition period, because we adopted 0801, there's been some other nuances that have come along the way. I honestly don't think, at least from a SaaS perspective, it'll be as impactful as it is for the perpetual software companies, depending on whether they did term licenses and how they structure their agreements. But there still could be some impact in SaaS, if you do multi-year deals where your prices change and it's not just based on some kind of index or assumed renewal rate. So if you've got leveling of how you charge your customers or how you do modifications in your contract. So there could be some work there. But I personally, at least from my experience at NetSuite, I don't think is as impactful to SaaS companies as it may be to the perpetual software companies. And then, but then there's also the issue we just talked about, which is sales commissions. So that could just be as impactful to SaaS as perpetual. It just really depends on, you had a policy election before, whether you wanted to capitalize or expense commissions. And so if you'd chosen to do expensing before, that's obviously going to be a much bigger impact to your company than others, regardless of whether they're in the perpetual or the SaaS world.
Makes a lot of sense. Well, I want to thank you, Mike, for spending time with us this morning on this topic. As you saw from the audience, obviously a lot of questions, and I'm sure you're getting a lot of LinkedIn requests for people that want to have further conversations with you. What I want to go ahead and do is just wrap it up with a couple of quick housekeeping related items. And as I mentioned at the beginning, really the next part of this, this is part one of a 4-part series that we're doing on RevRec. So part 2, we are doing an interview with KPMG and Prasad Kadambi, who's the lead audit partner there at KPMG, and he'll be giving his perspective on ASC 606. Part 3 will be Wall Street's take on 606. We'll also be covering about going public and the IPO market and a couple of other things. But really, we'll be featuring Kash Rangan, who's at Merrill Lynch, and Jason Maynard will be really leading that interview on April 3rd. And then, of course, we'll bring it all together at the end on April 19th, and we'll really do a full demo of what's the full solution for NetSuite around 606 and what we're doing and how we can help companies. And I know there's been a number of questions that have come through asking about, what is NetSuite doing to help companies with the transition? What is the NetSuite solution doing in this? And of course, our goal really is, of course, we want to be able to support all of those different. We do support all the different methods that people might choose. We really want to be there as a support mechanism to support you in whichever works well and works best for you and as a finance professional that you guys determine as a company. And of course, we can have more one-on-one discussion about that and have that further conversation. Many of you have also asked, how do we make sure and get registered for those other events? All of you that were on the webinar today and, of course, have registered for the webinar will get an email inviting you to these other events and to register for them. So we definitely encourage you to do that. We'll also make available to you an archive of what we spoke about today. So if for some reason you had audio issues or you had to log off or you'd like to listen to it again, we'd be happy to provide that to you, and you can of course review that again. And then one last thing I'll just mention is if you are either in the San Francisco or New York-based areas, we do have several 606-based events. One in San Francisco on the 16th of March, and one in New York on the 21st of March, and both should be great events that will have a lot of great information. So So with that, I want to thank everyone for spending time with us today and for making time out of your busy schedule for this. We hope it was useful for you. It was definitely interesting to see some of the results, and I look forward to speaking with you all in the future. Thank you.